Welcome back. Today we're talking about the foundation of smart investing, how to build long-term wealth without obsessing over stock charts. The secret, low-cost index fund ETFs, and nobody does it better than Vanguard. I'm breaking down the only 3 Vanguard ETFs you need for a growth-focused, diversified portfolio. No get-rich-quick nonsense, just proven, steady strategies. We'll cover what these ETFs are, why they work, and how to use them for your financial future. Grab a coffee, hit that like button, and let's dive in. This is the blueprint I wish I had when I started investing. First up, the ultimate in diversification, the Vanguard Total Stock Market ETF, ticker VTI. VTI gives you exposure to over 3,700 US companies, big, medium, and small, all in one fund. Instead of picking winners, you own the entire market, betting on the long-term growth of the US economy. This means you're cushioned if one sector struggles, thanks to broad diversification. The expense ratio? Just 0.03%. That's $3 a year for every $10,000 invested. Fees so low, they barely register. Low fees matter over decades. They can mean thousands more in your pocket. VTI automatically adjusts as companies grow or shrink, so you're always riding the winners. For most investors, VTI is a near-perfect core holding. Diversified, cheap and simple. You're not just buying a stock, you're buying the entire market. Over time, the market has a strong track record of growth. Set it, forget it, and let the American economy work for you. If you want one ETF to rule them all, VTI is it. That's why it's my top pick for long-term growth. Next, the classic Vanguard S&P 500 ETF, ticker VOO. VOO focuses on the 500 largest, most established US companies, the blue-chip giants. Think Apple, Johnson & Johnson, Visa, companies that drive the American economy. Why choose VOO over VTI? It's a more concentrated bet on stability and proven performance. The S&P 500 makes up about 80% of the total market's value, so VOO's performance closely tracks VTI. Expense ratio? Again, just 0.03%. Vanguard keeps more of your money working for you. VOO is the gold standard for index investing, simple, effective, and recommended by Warren Buffett himself. If you want exposure to America's corporate leaders with minimal fuss, VOO is a fantastic choice. It's a reliable way to participate in the market's long-term growth. Whether you pick VTI or VOO, you're making a smart move. VOO is for those who want a bit more stability and focus on the biggest players. Both are winners, but VOO is the powerhouse of large-cap investing. For steady, reliable growth, VOO delivers. Finally, let's add some spice. Vanguard Growth ETF, ticker VUG. VUG targets large-cap US companies with strong growth potential. Think tech giants like Apple, Microsoft, and Nvidia. This ETF is all about innovation and rapid expansion, not slow and steady dividends. VUG is more volatile than VTI or VOO, but it can supercharge your returns when growth stocks are on fire. The expense ratio is still low at 0.04%. VUG isn't for everyone. It's best as a supplement to your core holdings, not a replacement. If you have a long time horizon and higher risk tolerance, VUG can boost your portfolio's growth. It's a calculated bet on the innovators and disruptors leading the market. Use VUG to overweight the fastest growing companies and aim for higher returns. For investors seeking extra growth, VUG is a powerful, low-cost tool. Just remember, higher reward comes with higher risk. There you have it, the 3 Vanguard ETFs for building long-term wealth. VTI, VOO, and VUG. Mix and match them for a diversified, low-cost portfolio tailored to your goals. Remember, this isn't financial advice. Do your own research and invest according to your risk tolerance. The market will have ups and downs, but a solid plan wins over time. If you found this helpful, hit like and subscribe. Which ETF fits your strategy? Drop a comment below. Thanks for watching. See you in the next video.